This call is now being recorded.
Good morning, friends. Today, the topic for our discussion is deductions under Section 80C of Income Tax Act 1961. And this is Professor S. Ramesh Kumar Mehta from JSPM's Rajashri Sahu College of Engineering, Pune. So, let's discuss the list of items which falls under the deductions under Section 80C of Income Tax Act 1961. So, So these are the list of items which fall under the purview of Section 80C. So before I go into the discussion part, why this Section 80C is very important. Okay, there are so many deductions under Section 80, starting from 80C, 80D, 80 double CD, 80 double triple C, 80DD, so on and so forth, up to 80U for an individual. An individual can invest money in these instruments which fall under the category of 80C to 80U, and make deductions and take deductions under these sections. Okay, for example, Mr. S.R.K. Mehta is an assessee, and he's having a salary income of some 10 lakh rupees and a short-term capital gain of some uh, 5 lakh rupees, and income from other source in the form of dividend and interest and other is 2 lakh rupees, and income from business, he is doing some business of running tuitions or academic classes, and he has earned a profit of from 5 lakh rupees. So the total income now is 10 lakhs plus 5 lakhs plus 2 lakhs is 22 lakhs. So on this 22 lakhs, he is supposed to pay according to the slabs, income tax slabs, 0 to 2.5 lakh rupees, 2.5 lakh rupees, something like that, and he has to pay around 6 lakh rupees as tax. So almost, if you look here, 25% to 28% is taxed of the total income. So his concern is now, how should I, is there a way I can reduce my income tax and income tax liability? Yes, there are ways and means of reducing your income tax and an income, and that is legitimate and genuine. And for this purpose, there are some sections under Income Tax Act 1970 and 1961, starting from 80C and it ends to 80U. And today we are we are going to discuss about section 80C of Income Tax Act 1961. So what are the items which fall under section 80C? So the famous among them, or some of the most important ones, are provident fund, that is voluntary provident fund, number one. Number two, public provident fund, life insurance premium, equity linked savings schemes, home loan repayment of the principal amount, investment in Sukanya Samruddhi account, national savings certificate issue, infrastructure bonds issued by specified infrastructure companies, pension fund under section 880 triple C, investment in 5 years bank fixed deposit, senior citizen savings schemes, national pension scheme, 5 years post office time deposit scheme, NABARD rural bonds, investment in NABARD rural bonds, unit linked insurance plan, and tuition fees of the child, and some others. So let's look one by one in depth, so that we can get a comprehensive understanding about what are the different investment avenues under section 80C. So the first one under section 80C is provident fund. Is provident fund. So let's look at this particular investment avenue as a deduction under section 80C, which is provident fund, voluntary provident fund, or Provident fund is automatically deducted from your salary. Both you and your employer contribute to it, while employer's contribution is exempt from tax, uh, subject to some ceilings, and your contribution, that is employee's contribution, is counted towards section 80C investment. You can also opt to contribute additional amounts to voluntary contribution. Interest is tax free. Now what does it mean? For example, the total salary of an assessee is salary for the per month of the assessee is 80,000 rupees. So, and the basic salary is some 20,000 rupees. Here, the employer and employee can contribute to the employee's provident fund, and here the maximum amount can be some 12% of basic salary plus DA, and as far as the employee's contribution can be, it can be unlimited, because it is a employer's income. He can invest whatever he feels like. So in this case, whatever is the investment to provident fund of the employee by the employee for the whole year falls under as a is a allowed as a deduction under section 80C as a contribution to provident fund. For example, the total income of the assessee during the financial year 2019-20 is some 20 some 20 lakh rupees, and the employee has contributed to his own provident fund during the whole year from from April 2019 to March 2020. The contribution of the employee towards his own provident fund is some 2 lakh rupees. So his income is 20 lakh rupees, but under section 80C, this contribution towards provident fund gets deducted from 20 lakh rupees, and he has to pay tax on 18 lakh rupees. But however, one needs to keep in mind that under section 80C, the maximum amount of deduction is 1.5 lakh rupees, is 1.5 lakh rupees. So in this case, even though he has contributed to his own provident fund and voluntary provident fund of 2 lakh rupees, as this section says that only 1.5 lakhs is permitted. So 1 lakh rupees is 1.5 lakh rupees is deducted from 20 lakh rupees, and he has to pay tax on 18 lakh rupees. If this provision were not there, or he has not invested his amount in voluntary provident fund or provident fund, then he should have paid his income tax on 20 lakh rupees, as his income is 20 lakh rupees. Hope you have understood that advantage of section 80C. You get deduction to the tune of rupees 1.5 lakh in aggregate in all the items under section 80C, 80 triple C, and 80 double C D. Number two item under section 80C is provident fund, public provident fund. Okay, so any person, whether he's a farmer, a salaried person, or an entrepreneur, or a general public, or a businessman, or a politician, whatsoever may be his avocation or profession, he can invest in a public provident fund, and it has to be opened with any bank, specified bank, and State Bank of India is one nominated bank where you can open a provident fund account, public provident PPF account we call it, and start investing it, and you will get deductions under section 80C to the tune of 1.5 lakh rupees for the whole year maximum what you have invested. So this is a provident fund. This can be an employee provident fund where he's a salaried person, and whereas public provident fund, as the name itself suggests, that any public can invest. Any public can invest. He can be a farmer or agriculturist or a politician or a businessman or a lawyer or a doctor and self-employed entrepreneur, or any public can, whosoever is interested can invest and claim deduction under section 80C under the head public provident fund. So among all the assured return small savings schemes, public provident fund is one of the best. Interest is so here in this case interest amount is compounded yearly, and the normal or the maturity period as far as provident, public provident fund is concerned, is 15 years. The minimum contribution what you have to do is 500 rupees for the whole year, and maximum 1.5 lakh rupees. A point worth is noting is that interest is rate is assured but not fixed. Also, the interest on public provident fund is exempt on under Income Tax Act 1961. So, if any interest is generated and paid on the date of maturity during the on the date of maturity, then the interest which is earned is totally exempted under Section 10 of Income Tax Act 1961. This is number two. Next one is very, very important, which is life insurance premium, and you are paying life insurance premium on a life insurance policy of the assessee is a spouse or as specified by the income tax rule. So this is a other avenue for investment under section 80C. So if this is nothing but to protect your life from health, accidents, so on and so forth. So any amount that you pay towards life insurance premium for yourself, for your spouse, for your children can be also be included under section 80C. So for example, you have taken a life insurance policy and the policy amount is some 5 lakh rupees, and every year you are paying a premium of 50,000 rupees to keep in force and to keep in force your LIC insurance policy on every year as specified as required. You are paying a premium of 5,000 50,000 rupees for 20 years. This particular scheme is for. So in this case, this 50,000 rupees you can claim as a deduction under section 80C towards the premium paid for LIC policy, subject to a maximum of 20% of the policy amount. For example, in this case, it is 10%. 50,000 is paid on 5 lakh rupees, so 10% of the value of the policy amount. For example, in this case, it would have been like 1.5 lakh rupees the premium you have paid. So keep in mind that you can be allowed only 20% of the policy amount. So here, when I'm talking about 20% on 5 lakhs is 1 lakh rupees. So 1.5 lakh rupees is not allowed because the maximum contribution to the premium of the LIC policy, that is the life insurance policy, which is allowed under section 80C, is 20% of the uh, premium, 20% of the policy amount. So which is 1 lakh rupees. Even though you have paid 1.5 lakh rupees, you can claim a deduction of 1 lakh rupees only. So this is the third uh, investment avenues for claiming deduction under section 80C. So you have seen employees provident fund, voluntary provident fund, public provident fund, investment in public provident fund, and premium paid towards LIC policy of the spouse, your yourself, your children. Then you can claim all these as deduction under section 80C. This is number four. Number four item which falls under the uh, investment avenues of section 80C, which is equity linked saving scheme. Equity linked saving scheme. Okay, this is generally equity linked saving schemes are promoted and marketed by mutual fund companies. Mutual fund companies. For example, uh, HDFC tax fund, HDFC tax fund, or Axis Bank, Axis Axis Bank ELSS scheme, equity linked savings schemes. The scheme, let's talk about the scheme here. For example, if somebody has invested in equity linked savings schemes on 1 lakh rupees, so we'll get a deduction under section 80C. This is the first particular feature this ELSS has got. Number two is all this amount of 1 lakh rupees is invested in blue chip companies which are listed on the stock market. So this guy who has invested in ELSS scheme, that is equity linked savings schemes, has got the first benefit of claiming the tax exemption or deduction under section 80C, number one. Number two, he is even ensuring that this amount is invested in stock market, because he may be interested in investing in stock market. So the dual purpose is solved. One is 1 lakh rupees is the tax he can tax exempt deduction he can claim under section 80C by investing in 80 ELSS, number one. Number two, this 1 lakh rupees is invested by the mutual fund or asset management company in a blue chip in a set of blue chip companies like Reliance Industries, Tata Consultancy Services, or Wipro, or Infosys, uh, Axis Bank, ICICI Bank, HDFC Bank, so on and so forth. All these chip companies are the ones in where this amount is invested. So he can ensure a suitable rate of return, even though that rate of return can be varying depending upon the market conditions. This is the feature or a character of a ELSS scheme. One more character of ELSS scheme is, once you have invested in ELSS scheme, that amount will be blocked or locked for 3 years, and on the maturity of or completion of 3 years, you can you can liquidate it, or you can uh, ask for redemption from the specified mutual fund or asset management company. So this is the fourth category under section 80C. The first one is public provident fund. Number two is employers provident fund. Number three is voluntary provident fund. Number four is ELSS, and number five is life insurance premium paid towards life insurance policy. Now number six under section 80C list of items is home loan repayment of principal amount. Home loan principal principal repayment. For example, Mr. X, who is an assessee, has taken a loan from bank for the construction or purchase or acquisition of house property, and he has taken some 25 lakh rupees. And this is loan is taken for 15 years, and it was taken in the year 2016 17, and the maturity and he will be paying this loan for 15 years, or this loan amount will be spread over 15 years. So in the year 2019-20, he is paying the loan repayment. So he is paying interest as well as principal repayment. So prince in this interest, whatever is paying during the financial year 2019-20, can be claimed as a deduction under section 24 of income under section 24 of income from house property of income tax 1961. Now, whereas the principal repayment what he is paying out of this, uh, whatever he is paying during the financial year 2019-20 can be claimed as a deduction under section 80C towards home loan principal repayment. So, for example, he's paying some 2 lakh rupees as home loan home loan principal repayment. He can claim this home loan principal repayment under section 80C. And please remember, under section 80C, the maximum amount which can be deducted with the maximum ceiling is 1 lakh 50,000 rupees only. Hope you have understood it. Next one is Sukanya Samriddhi account. This is the next item which falls under the list of investments under section 80C. Under 80C. So Sukanya Samriddhi account can be opened at any time in a bank from the birth of a child till she attains the age of 10 years, the minimum deposit of 250 rupees. So minimum deposit you have to do 50 rupees, 250 rupees, sorry, and you can, this account can be opened at any time from the birth of the girl till she attains the age of 10 years. This is number one point. Number 2 point, a maximum of 1.5 lakh rupees can be deposited during the financial year. So minimum is 2 lakh 50,000 rupees, sorry, 250 rupees. and maximum investment is 1.5 lakh rupees uh, can be invested. Number three, interest on this is fully exempted in the year of accrual as well as in the year of interest. So if there is any accumulated interest on this 1.5 lakh rupees, it is fully exempted under section 10 of Income Tax Act 1961. Okay, so these are some of the provisions related to Sukanya Samriddhi account. Sukanya Samriddhi account meaning Girl Child Prosperity Scheme. So Girl Child Prosperity Scheme is a special deposit scheme, which is a special deposit scheme launched by the Prime Minister Sri Narendra Modi ji on 22nd January 2015 for a girl child only. So whatever amount is been invested during the financial year, he can claim as a deduction under section 80C, but to a limit of a maximum ceiling of 1.5 lakh rupees. Next one is National Savings Certificates. In short, we call it as NSC under 8th issue. Okay, so let's look at some of the provisions under section 80C as far as National Savings Certificates 8th issue are concerned. National Savings is a time tested tax saving instrument with a maturity period of 5 years. So maturity period is 5 years. Interest rate is compounded yearly. The minimum investment is 1,000 rupees. Maximum is there is no amount, no maximum amount prescribed. You can invest whatsoever you want. Premature withdrawal are permitted only in specific circumstances such as death of the investor or the holder or any other uh, ones which are specified. Investment in national savings certificate are eligible for a maximum reduction of rupees 1,50,000 as already discussed under section 80C. So this is about national savings certificate. Next one is infrastructure bonds. So the meaning of the bond is long-term investments. Infrastructure may be telecommunication, investments in ports, national highways, or ports, or so on and so forth. There are companies which are operating in infrastructure like electricity, power manufacturing. So these companies may issue infrastructure bonds, and these infrastructure bonds uh, are approved for investment under Section 80C. So you have to look at this clause whether this investment in infrastructure bonds is eligible for deduction under Section 80C or not, and then you can invest in these kind of infrastructure bonds issued by the infrastructure companies. So there are also popularly called as infrastructure bonds. These are issued by infrastructure companies and not the government. The amount that you invest in these bonds can be included under Section 80C as a deduction. Next one is pension fund. So we are talking about Section 80CCC. Please remember 80C plus 80CCC plus 80CCD. The total aggregate amount which can be claimed as a deduction is rupees 1.5 lakhs only. Okay, this section 80CCC stipulates that an investment in pension funds. So pension, we are talking about retirement. After retirement, what is the source of income? So you invest right now for you getting a amount as pension which you can enjoy during your retirement. Okay, so this section 80CC stipulates that an investment in pension fund is eligible for deduction from your income. 80CC investment is clubbed with the limit of 80C. Already told 80C plus 80 triple C plus 80. We'll see even 80. We'll talk about 80 double CD also, and all this put together, the total aggregate maximum you can invest whatsoever you want, but the maximum amount which can be claimed as deduction is 1.5 lakh rupees from the total income. Number one. Number two, this is also means that your investment in investment funds up to 1.5 lakhs can be claimed as a deduction under Section 80C. However, as mentioned, the total deduction under Section 80C and 80CCC cannot exceed rupees 1.5 lakhs. So this is the next item under the list of items under Section 80C. which is 5 years fixed deposits. So if you invest in 5 years fixed deposits of a scheduled bank for a tenure of 5 years, means it will be locked for 5 years. Then if it is a tax saving fixed deposits, then you are entitled for deduction under section 80C to a maximum limit of 1.5 lakh rupees, the investment amount. So you go to ICICI Bank, you invest in tax saving fixed deposits of 6 lakh rupees, for example, for 5 years. So you can claim reduction from your total salary under section 80C. Despite the fact that you have invested 6 lakh rupees, you are allowed to have a deduction under section 80C, a stipulated maximum limit of 1.5 lakh rupees. So this is about senior citizen savings schemes. Next one is NPS, National Pension Scheme. Amount contributed for a fixed period of not less than 3 years by central government employees to this NPS, National Pension Scheme. Then this also falls under the list of items under section 80C. Next one is post office time deposits. Time deposits are nothing but deposits. Okay, so if you are investing in post office time deposit scheme, these are the schemes which are floated by the post office, that is the central government. So if you invest in 5 years post office time deposit scheme, then you can claim whatever amount you have invested in this scheme under section 80C. Maximum is 1.5 lakh rupees. Interest is compounded quarterly but paid annually. The interest is entirely taxable. So this is about 5 years time deposit scheme of the post office, which is called as POTD. POTD, post office time deposit. Next one is NABARD rural funds, rural bonds. So if you are investing in NABARD, National Bank for Rural Development, and they are floating rural bonds, and if you are as SSC, you are investing in these rural bonds, there are several types of bonds issued by NABARD Rural Fund bonds, sorry, Bhavishya Nirman bonds. Out of these two, only NABARD Rural bonds qualify under Section 80C, and the maximum amount of investments one can invest for claimant deduction under Section 80C is 1.5 lakh rupees. Next one, unit linked insurance plan. Unit linked insurance plan. Okay. Now let's talk about unit linked insurance plan. So uh, unit linked insurance plan, ULIP we call it in short. There are several advantages of investing in unit linked insurance plan, and one of the schemes of UTI is a unit linked insurance plan. Okay, there are several other companies which are into mutual funds or insurance business. They also have ULIP, unit linked insurance plan, but I'm going to talk about UTI ULIP scheme. So, for example, if I have investing in UTI ULIP scheme, I got triple advantages. Number one is my insurance is covered. Insurance is covered. For example, I have invested 75,000 every year in ULIP. So my insurance is covered to the extent of, for example, 10 times, 7.5 lakh rupees. So if I die, if an accident takes place, if due to health I die, so I to my family, it will be released to my family members because of the advantage being an insurance coverage under ULIP. Number two is tax reduction, tax exemption under Section 80C. So you get insurance plus tax exemption, tax benefit. We call it as tax benefit. And apart from this amount which is collected by the concerned mutual fund company or asset management company or insurance company, they invest certain amount of money, percentage of money in debt schemes and certain amount of money in equity schemes. That is in blue chip companies and government of India securities or any other investments where a fixed rate of interest is given. So I will get a benefit of insurance, tax benefit, investment in equity linked savings schemes, and investment in equities as well as investment in debt securities. So this is about unit linked insurance plan under section 80C of Income Tax Act 1961 as a element of tax deduction. And last one under section 80C is tuition fees of children of the assessee. For example, Mr. X is there and X has a daughter, and the daughter is studying in 10th class, and the assessee is paying to the school a fees of 1 lakh rupees. And out of this 1 lakh rupees, for example, in this case 50,000 is towards tuition fees. So this tuition fees of 15 lakh rupees, 58,000 rupees, sorry, can be claimed as deduction under section 80C. So these are some of the uh, investments which an assessee can do to claim deduction under section 80C of Income Tax Act 1961. Hope you have understood each and every element of investment avenues under section 80C. And if at all, if you have any doubts, you can get back to me on my WhatsApp. And have a nice day. Stay safe and keep smiling and enjoy life. Thank you so much for your patience listening. See you forward for my next video on different aspects of Income Tax Act